Welcome back. We've got Rana Gupta also joining us this morning from Manulife Investment Management. Rana, good to have you with us as always. Let's talk about the kind of mood that you see markets really trading under currently. We've got the overhang of the yield curve. We've got some worries about a faster than expected recovery in the US, ironically. But what is the kind of impact or the resulting impact you see that having on flows into EMs like India going forward?
Right. As you rightly pointed out, that it is the rates are rising, and rates are rising for a good reason, which you also alluded to, that because of the stronger than expected economic recovery that we're going to see. Now, stronger than expected recovery would mean that the global trade is going to perhaps pick up, and that is a positive. On the other hand, on the financial channel, right, there could be some even outflows from emerging markets because the US is doing so well, so on and so forth. That said, I think there are a few things to highlight, and for which we believe that overall, barring a bit of positioning change here and there, overall the flows to emerging markets which can deliver good growth should remain pretty robust. Now, the reason being that in case of, let's say, emerging markets like India, where the external accounts are pretty good, the fiscal situation is under control, there is a series of reforms that has happened over the past few years, and the growth is set to pick up pretty robustly. In such cases, we think that the flows should remain robust over a period of time. That said, given the rise in rates in US, rise in sequential growth in US, and also given the COVID surge and specifically that happened to India, in the very shorter term, certain amounts of volatility cannot be ruled out.
Okay, fair enough. Do you think that, to some extent, we will see attention shift, for instance, to financials, industrials, materials? I mean, we've already seen, a lot of interest building up across cyclicals. But going forward, do you see continued conviction there or a move back towards defensives?
Again, you have to break it down in the very short term and medium to longer term. In the very short term, I think the defensive sectors have underperformed, and given the rise in yields and given the rise in, or rather given the more of the COVID situation, there could be some accumulation of the so-called defensive sectors. However, for medium to short term, we believe that rates will probably remain here or even rise a little bit from here due to the good economic recovery. That will have implications for price to earning ratios. Now, most of these defensive stocks over the last 5-7 years, they have seen significant PE ratio derating. What could happen due to higher rates is that those PE ratios can come off, although they remain great companies, but the stock price return could be subdued or limited from here. On the other hand, I think US Fed has said that they will be reactive, so they will let the economic conditions recover comprehensively before they talk about rising rates. This means at the shorter end, real rates will remain negative, which should be pretty good for the cyclical sectors. And cyclical sectors agreed that they have rallied quite a bit from the bottom, but this is like a normalization process. And we do believe that cyclical sectors going forward, if you take a medium to longer term view, have much more juice left. So yes, I mean, if there is a volatility and the cyclical sectors tend to underperform, we would think that that is an opportunity with a medium to longer term view.
Rana, what if there is an inflation scare which nobody is realizing? Today it appears that this is growth which is driving interest rates higher. There is no panic in the market, but inflation is a genie. Once it's out of the bottle, you cannot put it back. What we look right now looks like growth could actually be hidden inflation.
So I think the inflation spike, I think what you are referring to, is it a possibility? Is it a risk to the equity markets? Can it happen? It can. However, our view is that if you think about, let's say, this year, CY21, this more of inflation. We will have to wait and see how the growth pans out. The inflation is more of probably a CY22 phenomena, if at all, that comes through. However, I think a bit of inflation is welcome because, I think for equities, what matters a lot is the real rates. If inflation goes up and the rates our rates and real rates are negative, that is again good for hard assets and the commodities and the growth oriented and cyclical sector equities. It may not be as good for the defensive sectors as we that done so well in last 5-7 years. So to that extent, there has to be a change in way, change in the stance in the equities in terms of which sectors one goes overweight or not. And I think the concern would be if inflation spike happens to the extent it goes above and beyond the higher limits of the central bank's comfort zone. Whether that will happen or not, it's we are not sure. Is it a risk? Yes. Even if it's a risk, it is not in any near to medium term we see that this playing out.
How are you investing in the PLI dominated themes in India? Because PLI schemes are here from pharma to manufacturing, from textiles to electronics, everyone would benefit. Are you looking this as a big pocket where it makes sense for investors like you to start investing?
Oh, absolutely. I think that growing share of manufacturing has been a consistent theme for us for last about almost more than 1.5 years now. It all started with the tax rate cuts, then came the import duties, and then PLI. So it has been a series of steps that the government has taken to rejuvenate the manufacturing sector. Now, in manufacturing sector, in our earlier interaction, we must have shared with you that we like consumer durable ancillaries, and those companies have significantly re-rated. Now, with the more details of PLI scheme out, what we think is that one can even look at the brand owning companies which are at the moment producing very less on their own, but have definitive plans to move into manufacturing and increase the share of value addition within India. This will help them in two ways. A, they will have much better control on the working capital and margins. B, because they are putting this manufacturing plants in, they will have some incentives. And also, with better manufacturing and better incentives from PLI, these stocks may even see a re-rating. So I think the next phase of trade could be the companies which are brand owners, produce less today, but can produce much more tomorrow.
Sure. So in light of that, Rana, you've all often mentioned that you're backing companies that are levered to the economic recovery, where top line can grow with economic recovery, companies that can control their costs as well, especially in the post-pandemic era, and are trading at or at least lower than their average PERs. Where within this entire umbrella or contour do you find value in the market still?
So so first of all, once you look at top-down view, which we were discussing so far, typically the financials, industrials, materials are seen as cyclical sectors. Now, the points that you raised, the attributes that you raised are mostly bottom-up. Now, if you think about all those characteristics, when the economic growth picks up, a bank's credit growth pick up, for example, industrial companies get more order. If there are more real estate construction, then the building material companies' top line keeps on growing. Additionally, what has happened in case of India, some of these financial, industrials, and building material companies, because of first demand, then GST, and now due to COVID, the competition from the unorganized sector is now pretty limited. So they get benefit on that count also. They actually increase market share in a market which is growing. So their revenue should be good. Now, many of those companies, particularly manufacturing ones, they're operating at much lower than their rated capacities. So therefore, no incremental capital is required for them to increase their capacity, some of these companies. So therefore, with growing volume, they can maintain cost. And some of these companies across these sectors, financials, then in the home building space, the building material companies, whether you think about ceramics, pipes, tiles, all those things. So these companies are trading at a valuation which is at or even in some cases below average of their own trading history. So and we see their earnings recovering pretty strongly. So these companies, in our view, at the very least, they will give you returns in line with earning because the valuation is not high to begin with. But the bull case scenario could be these companies can see some P re-rating as well.
Sure. You've often also talked about companies which are putting in more assets on the ground. They're trying to reduce sourcing, increasing exports. I'm guessing this is going to be very case by case. You can't really put a blanket sector call to this.
Oh, absolutely. This will be the part of the manufacturing question, which I think you asked earlier. So in the manufacturing case, say if some company is putting a new assets on the ground because of whether it's a tax cut, whether it's a PLI, whether due to imported production, or maybe it's due to their global clients are outsourcing, reducing outsourcing from China, increasing to other emerging markets, including India. There is a big opportunity there. And the companies who are putting in these assets, they will benefit out of either import substitution and or growing exports. And you're right, these companies cannot, one cannot identify in one particular sector because those examples are across sectors. But I think the most, if I were to pick one sector where the valuation is still not very high, and there is possibility of more stock price return, I would say probably chemicals is one sector where you see demand from multinational companies. There is demand for import substitution, and these companies are putting in the capex on the ground. The valuations have gone up, no doubt, but they are not. I think those valuations in the context of the earning growth and ROE are still reasonable. So I think that is one sector, and there are other sectors, but these have become very bottom of opportunities. Whether it's in the auto ancillary sector or within a pharmaceutical sector, those become very, very bottom of opportunities.
All right, it's been a pleasure chatting with you, Rana, just to understand, what it is that you're betting on in the current environment, how you're looking at the kind of booster shot as well that has been given from the government and what this means for various sectors. Thanks so much for joining in.